All right, these O shares have been just hitting it out of the, I want to say effing park, but that's the honest truth. That's honest truth. I remember when you were getting these things going, it was actually at this event, or this was part of it. Ready? Been balling a shiny back steel jackhammer, been chipping up rocks for the great highway. So this was Kevin. This was Kevin at the Benzinga FinTech Awards, playing the guitar in front of a packed 1,000 people way back when, Kevin. And that was a YouTube celebrity. I don't know if he still is. Anyway, O shares. I mean, there's so many things I could say. I mean, OGIG, OUSA. I mean, all of it. And I remember the thesis with your mom about dividend stocks. But like, what's your take? Like, how do you decide what money to put in each one of those things? Like, if someone's listening right now, because I've had about a bunch of questions about the ETFs, how should they think of how to allocate money into O shares?
Yeah. So the reason I became an owner of an indexing company, because that's what O shares does. It designs indexes. It's sort of financial scientific rule development, and then it creates ETFs. And I wanted to be part of that so that I could. My whole thing about my trusts actually are nowhere near as speculative as the stuff I do in private, you know, all the Shark Tank companies, all the other investments I make. I have to find a way, because I have generational skipping trusts that support all kinds of charities, family members, and whatever, and we distribute 6% a year. So for me, it's not trying to beat the market. I'm trying to find ways to preserve my capital. So my largest holding for equities is, you know, in an index is OUSA, because it looks at all the S&P 500 companies and says, okay, which ones are broken, which ones return on assets are declining, which ones are getting hammered by policy or whatever, and it's showing up on their balance sheet and in more debt, like the airlines or like the energy companies. I only want to own the ones that really will continue to profit, reduce debt, and have high return on assets. So that's only 100 of them. You know, out of the S&P 500, I own 100 stocks in OUSA, and that's 40% of my portfolio. And it pays a distribution. It's in the form of dividends and profits, but it's really designed to, I don't want to participate when the market corrects, and it will, it always does. I don't want the drawdown. I don't want to participate in 100% of the drawdown. So if the S&P goes down 30%, I want to I only want to go down 20% or less if I can. And that's the kind of thing you get with a portfolio like O shares. So it's not really trying to beat the market. It's trying to protect you on the drawdown and give you stability. That's, really it's the core. Then for growth, and this is something you guys talk about all the time, I don't look at PE in growth stocks. If you looked at price earning ratios, you would have never bought Amazon in the last 17 years. It's always been expensive. The only metric, there's two metrics I look at in a stock, in a growth stock, and a lot of them are tech companies. What is the revenue growth quarter to quarter? Every 90 days, I want to see 20, 30, 40, 50% annualized growth rates, because that's what you get out of a great growth company. And I want to see the quality of the balance sheet go up with more cash because they're profitable. And that's how OGIG came to in existence, because I was writing all these checks to, Shopify, to CrowdStrike, to Zoom. I didn't even know what Zoom was 24 months ago. And now I'm a big shareholder in it, and I certainly use it every day. And, all of these tech companies had these growth metrics. And so if you look at what's inside OGIG, I bet you don't even know the names of 2/3 of those companies. But they way outperformed the FANGs. They grew much faster. The FANGs are what held back OGIG. OGIG was up over 100% last year. To me, they're only in the third inning. They're not stay-at-home stocks. They're work-from-anywhere stocks. And that's 15% of my employees are going to work from wherever they want to going forward. Some of them have never met each other except on using technology to do so in person. And that's going to be the new America. So I use these ETFs. I'll disclose my weightings. I got 40% in OUSA, 20% in OUSM, which are small caps. So a subset of the Russell 2000, the profitable companies. So there's a couple of hundred out of the 2,000 that actually make money. That's what's inside OUSM. So that's 20%. I put 20% into Europe, 50 companies there that everybody's heard the names of, the Pfizers and the Nestle's and all that. Good balance sheets. That's another 20%. And then for my growth, I do OGIG, 20% there. That's 100% of my equities in these mandates, in these trusts. And hey, it's one way to do it, and I'm very comfortable. I know the people have developed the rules because they work for me. It's great.